Hi, good afternoon and good morning to everyone. We have started our webinar. Welcome to today's webinar, Base Metal Outlook and Product Updates. I'm Meng Na and I'll be your moderator today. This is the second of our webinar series hosted by Straits Financial Group. Let me share my screen. A brief introduction of Straits Financial to the audience who are new to the channel. Headquartered in Singapore, Straits Financial Group is the brokering division of CWT Group, a global leading provider of integrated commodity services. Our global subsidiaries are located in Chicago, Shanghai, Jakarta, and Dubai. Our products cover, but not limited to, exchanged traded futures and options. Hi. Cleared futures, FX, OTC broking, cryptocurrency products. Through our Asian branches and global partnerships, we're focused on delivering a wide range of financial services and helping our clients achieve their investment goals. Back to our webinar. Here is the agenda for our webinars today. We will hear 5 industry experts and economists share their perspectives on base metal market outlook, as well as product updates. At the end of the webinar, we will have the Q&A session. Now, please let me introduce our guests today. Let me end our slides and you can see your video. Our first talk today on COMEX copper, aluminum, and iron ore products development will be presented by Sachin Patel. Hi, Sachin.
Hi there.
Sachin serves as Senior Director, Metals Products, Asia Pacific for CME Group. He is responsible for expanding CME Group's metal business and developing new opportunities across the region. Prior to joining CME Group, Sachin had 10 years experience at Bank of America Merrill Lynch Global Commodities Division, managing the commodity derivatives sales and structuring business in Asia Pacific. Welcome, Sachin, for joining the panel today. Our next guest, thank you. Our next guest is Eric Noland, Executive Director and Senior Economist of CME Group. Hi, Eric.
Hello.
Thank you very much for joining us. Eric will give us a talk on commodity and metals macro outlook. Eric is responsible for generating economic analysis on global financial markets by identifying emerging trends, evaluating economic factors, and forecasting their impact on CME Group and the company's business strategy, and upon those who trade in its various markets. He is also one of CME Group's spokespeople on global economic, financial, and geopolitical conditions. Thank you very much, Eric, for joining me today. Our next guest is Yi Zhu, Global Head of Metals and Mining, Bloomberg Intelligence. Hi, Yi. Welcome to join us today. Yi has more than 15 years of experience in the metals and mining sector. Prior to joining Bloomberg Intelligence, she was a research analyst for Goldman Sachs and Royal Bank of Scotland in Hong Kong, covering commodities. Yi also has a strong background in industry research and commodity trading by having worked for metal producers, including Aluminum Company of America and Shenhuo Aluminum in Shanghai. Yi will give a talk on Base Metal Outlook 2021. Thank you, Yi, for joining us. Today, we will also have two in-house speakers from Straits Financial, Hou Zhenhai and James Wang. Hou Zhenhai is our Chief Strategist at Straits Financial China. Welcome, Mr. Hou. Hi. He will share his perspective on the macroeconomic and investment outlooks in Q4. Hou Zhenhai has more than 20 years of commodity industry experience in China. He started his career at GKN Group in China and then served at the Wisconsin Foundation after obtaining the MBA degree. He served 6 years at China International Capital Corporation as the leader of the Overseas Strategy Team and A-Share Strategy Team. Mr. Hou and his team was honored the top team for the New Fortune Sell-Side Strategy Research in 2008 and the top team for Asian Money China Strategy Research in Hong Kong. Thank you very much for joining us. Last but not least, let's welcome James Wang, VP, Futures and Options at Straits Financial Group. Hi, James.
Hi, everyone.
James will give us a talk on base metal inter-exchange arbitrage opportunities. James Wang is currently the Vice President at Straits Financial. He comes with 16 years experience in commodity markets. Before joining Straits Financial, he worked for a variety of financial institutions, most notably Hong Kong Exchange, LME, Societe Generale, Mizuho Corporate Bank, and China International Capital Corporation. His working experience include being a marketing rep with Hong Kong Exchange, marketer with investment banks, focusing on commodity derivative sales in Greater China. Thank you all for joining us today. Now, without further ado, let's welcome our first speaker, Sachin, to give us a talk on COMEX copper, aluminum, and iron ore products development. Welcome, Sachin.
Thank you, Magna. Thanks for the very warm welcome into the whole Straits Financial team for having me today. Good afternoon or good morning to Eric and the fellow presenters and panelists. And it's been such a strange and I guess awful year in so many ways. And certainly from a work perspective, I really enjoyed and relished the occasional opportunities such as today to do a presentation or participate in a conference. It's something that, breaks up the day of staying at home and, gives us a chance to give something back to our clients in a year where actually meeting most of you face to face has been pretty impossible. So thanks again to Straits. And, for the next, 15 minutes, I'll get into an overview of the developments of CME's copper, aluminium, and iron ore products over 2020, give an overview of how the business has gone, some of the key themes that we've seen across the last 11 months. And I thank you all in advance for listening. Magna, am I sharing my own slides?
Sure, let me share your first slide.
Okay, perfect.
Are you seeing it?
Wonderful, I can see it.
Great.
Okay, so as usual, we begin with a long and small disclaimer. So a few seconds to read through this on behalf of CME Group before we get going into the meat of the presentation. Okay, I think that's long enough. So let's begin. Very briefly, I think many of you will be very aware of CME Group and have maybe seen this exact slide before, but let me just quickly go through the main points here. So, of course, we are the world's leading and most diverse derivatives exchange, access in over 150 countries with 11 global trading hubs and various partnerships around the world with partner exchanges. I guess for me, the most important thing to highlight about CME Group is from a metals perspective, we form only one of 6 major asset classes, along with our financial products of rates, equity index, and FX, and then metals, energy, and agriculture on the commodities side. So a really unique organization whereby we have excelled and become market leaders across such a wide range of different asset classes. And today, of course, I'm very happy to be talking to you about the metals side of this. Now, just to highlight the broad offering that we have, and of course, we will only be focused on a handful of what you see in front of you today, but for the metals business at CME, we break it down broadly into three main sections. The middle section, precious, is, I guess you have to say, what we are best known for in the market. Our oldest set of products going back to the 1930s, when we launched silver futures, and really the largest part of our business. After that, you have base metals, where in particular our copper futures and options have demonstrated tremendous growth in the last 10 years. And we are now really working hard to expand this into other base metals, starting with aluminium, which I'll come to later on in my presentation. And then finally, ferrous. Ferrous metals, a really interesting part of the metals derivatives chain. As a overall part of the metal spectrum, you would have to say that by market value, the ferrous space, of course, including steel, is actually the largest sector of metals. But from a derivatives standpoint, is, I would say, arguably the most underdeveloped. And CME over the last 5 years have really led the way out of international exchanges to develop a ferrous suite of products, starting with our hot roll coil futures. And we have now come to the stage where we are making yet another push into the iron ore space, which I'll touch on at the very end of my presentation. So one thing that I always like to do when talking about metals at CME is just to contextualize and give an example of how important the Asia-Pacific region has become for CME Group's metals business. So I've just shown this chart where in the taller light blue columns, you can see our daily average volumes each year across the entire business. And then the smaller columns here in dark blue are the Asia-Pacific volumes isolated. And by that, I mean clients from the Asia-Pacific region. And what I want to show here, of course, you can see we still remain only 16% of overall volumes. But the overall growth over the last 5 years has been outsized in Asia-Pacific. Asia has by far and away been the fastest growing region for our metals business. And so you can see 5 years ago, we were only 10% of our volumes from Asia, and that has increased 60% year to date so far in 2020. So outsized growth from the Asia-Pacific region. The other thing that I like to look at is how much metal is being traded on CME during Asia-Pacific hours. So here is a very similar chart. We have our total average volumes in the light blue, and then in dark blue, we're showing the amount of those volumes which trade in this 12-hour period, 8 a.m. to 8 p.m. Singapore time. So really, we want to show the volumes that trade when New York traders and Chicago traders are not working. They are probably not at their desks yet. And again, you can see this year we've hit another all-time high at around about 24% of volumes traded outside of US hours. And in fact, as I will come to, in some of our benchmark products, for example, copper, that number is significantly higher, and on some days could be as high as 45%. So these two things to show the importance of our region here, how much Asia-Pacific clients are trading, and when our total volumes are transacted. And it really is painting this picture that the Asia region and the Asia time zone is becoming more important from a trading and risk management perspective. So my next few slides, I will go through product by product and just give an overview of what we've seen in terms of the product growth. So we're going to focus on industrial and ferrous metals. Of course, my natural starting point has to be COMEX copper, which is our benchmark copper, our benchmark base metals contract. COMEX copper has existed since the 1970s, but it's really, I would say, in the last 10 or 12 years that we've started to see this really outsized growth from the wider marketplace. Now, my background is actually a commodities trader and investment bank for about 10 years. And I can tell you, when I moved out to Singapore in 2009, it was actually very rare for me and my business to pay too much attention to the COMEX copper price. And it was very, very rare for us to trade it. Fast forward 10, 11 years to 2020, and how things have changed for a number of reasons. So one thing that we can say is our liquidity. When can you trade COMEX copper? So this third bullet point, I do truly believe that this bullet point here, 23 hours per day liquidity, I cannot overstate the importance of this when you compare with other industrial metal markets around the world. We only have 1 hour in the day that COMEX copper market is closed, and that is at 6 a.m. to 7 a.m. Singapore time, or 5 a.m. to 6 a.m. When we're out of daylight savings. So it is almost round the clock, 5 day a week continuous liquidity. This has become ever more important. Linking back to what I was just saying about how important Asia is becoming for metals trading in general, we continuously see moves in metal prices outside of US hours. And that has been particularly obvious in the last 4 years, where maybe a headline or a Twitter can move things early in the day in Asia hours. And so COMEX copper has really become that barometer for the international copper price, and something that is accessible for longer than any other exchange-traded copper derivative. To give an example of size, this year over $7 billion worth on average of COMEX copper are trading every single day. Of course, it's got to be obvious here that it hasn't just been a straightforward rise. We had this period where our volumes doubled in just a few years. And 2019 and 2020 have definitely been a slower time for the copper market. And CME's volumes are down, but you would typically find that we would not be the only exchange whose industrial metals have not been able to keep pace with the very high standards set in years gone by. And I think there are plenty of reasons for this that perhaps Eric may even touch on, but I personally would attribute it to the trade war over the course of the last 2 years, making a decision, an investment decision in particular, on copper an exceptionally difficult thing to do. So I like to think of this in 2019 and 2020, our market normalizing somewhat. And we are back now to doing around about 100,000 lots per day on average this year. This last point, as I mentioned, copper is, if I had to pick one of CME's metals products as the most international, it would be copper. So on Sundays, literally almost half of the volumes trade before the traditional US hours. So that's the broad overview of our COMEX copper contract. In terms of who is trading, so one of the most important and often asked questions that I get, CME for some reasons has built up sometimes a reputation, an unfair reputation over the last few years. You are only the venue for the speculators and for the hedge funds, HFT, whatever have you. So our contract, as mentioned on the previous slide, is a physically delivered contract. Our market is underpinned in the physical. The physical is only delivered into the United States. But over the years, we have been an increasingly important part of the overall market and of cross-border arbitrages in particular. And I hope that James goes on to discuss about the arbitrages in the context of CME copper as well. But here I've shown very simply a graph which shows the open interest held by all the various market participants. And of course, while you can see that the managed money, which typically means the hedge funds, the large asset managers, tends to be our largest sector, this blue part is the second largest sector. That is labeled as producer, but you can generalize this to the true physical market participants. So it could be a producer, it could be a wire rod fabricator, it could be a physical merchant trader. So they are actually still the second largest part of our overall market, and even hold more open interest than the swap dealers, which is the investment bank. So I like to show this to demonstrate how balanced of a marketplace CME or COMEX copper has grown into. As mentioned, physical delivery. Our contract has always been a US physically delivered contract. I have here the different locations that you can deliver into. We have a different set of warehouse rules compared to some of the other exchanges. Probably most important is that no income is realized by the exchange from a warehouse rent revenue perspective, and we assign minimum loadout rules and facility capacities by individual warehouse, not by blanket location. So a few differences there between the actual physical delivery side of CME copper versus some other international copper exchange traded products. Now, sticking with the physical delivery aspect, CME copper inventory. This has become a more important thing to be aware of over the last, I would say, 5 years. If you go back for a period even before that, CME copper inventories were typically on the much lower side and probably not factored in as much into what we would call the global exchange derivative, the global exchange held inventories. Now, I think it's fair to say that you have 3 genuine centers of physical storage, which can make up these cross-border flows and cross-exchange arbitrage trades, of which relative inventories in different regions play a very important part. And CME copper, in fact, at the peak of our inventories, which was back either in 2018 or maybe towards the end of 2017, actually had more tonnage held. The LME did for a very short period of time, granted. But the point here is that no longer are we an exchange that sits on the sidelines with regard to the actual physical aspect. And it is an important part to keep in mind when determining entry and exit points into these cross-exchange ARB type strategies. So that's my overview of CME copper. It's been a strong year. We are up very slightly from last year's volumes. I'm sure Eric will go into maybe some of the price action. Copper was one of the first to be affected by COVID and was certainly one of the quickest to recover, up over 60% from its lows. So a really fascinating time for the copper market, where we have continued to see new entrants into our marketplace. So with that, we'll move on to CME aluminium. So again, this is a much newer initiative from CME's side. We have really only been pushing the contract from about this time last year, or third quarter in 2019. Some key highlights. First of all, the volumes that we saw in the third quarter of 2020 suddenly exploded. So we had this big increase from what was only 100 contracts per day to well over 300 contracts per day per last quarter. Of course, still very small in when you talk big picture, but huge growth demonstrated. Now, why exactly? What is CME aluminium about, and why are we so focused on it? So again, key aspects of the contract. It is a physically delivered future, but the key difference to copper is that aluminium on COMEX is deliverable globally. So we have warehouses in not only the US, but also in Europe, in Spain, in the Netherlands, of course, and then in key regions in Asia, Singapore and Malaysia. So Port Klang we've kept it simple with COMEX aluminium. So the pricing is actually the same as the industry benchmark. So 25 metric ton contract size, $1 per metric ton pricing. Now, it's similar to our copper contract, of course, a simple monthly future style contract instead of a rolling forward and carry market. So simple monthly futures, and we have market makers quoting the screen. I'll come back to that in a couple of slides time, but you typically will get out to 5 months of liquidity. So that is a broad overview of aluminium. As you can tell from the specification, it kind of looks and feels and smells a lot more similar to, for example, LME aluminium in terms of the specification and particularly the global delivery aspect of this contract. So with that, why, I'm going to skip forward one slide. So why would you look at CME aluminium? So there are many different reasons why you would potentially trade CME aluminium. Now, the fact that it's a monthly futures contract instead of rolling forwards in the carry market can have implications on the cost of entry and exit into your position. So there's always that to consider. However, we feel at CME, and I think this has been validated by most of our customers that have entered our aluminium market, the most interesting thing thus far in our short lifespan of COMEX aluminium is that there has been this very interesting basis or differential between CME aluminium and LME aluminium. So we have tried to graph this here by showing the price differential on a daily close basis between COMEX aluminium active month and LME aluminium 3 months. So this is COMEX minus LME. So you can see here, most of the time, CME aluminium is trading above or at a premium to LME aluminium. We've had these handful of instances where that ARB has completely reversed and got into a steep discount. But in general, the average is CME aluminium trades at a premium. And it looks as if whenever that premium gets to around $30, $35, and this has been validated by feedback from customers, we've had customers come in and do this arbitrage trade. It could be just from the paper side of buying and selling the different futures, or actually the physical arbitrage side of moving material from one exchange to the other. So I would say this is the main thing that our customers have been focusing on, this basis trade between two different markets. Now, in terms of the physical storage side, this is very, very important to point out. CME currently has just short of 50,000 metric tons. So again, it's been growing very quickly from almost tenfold from this time last year. However, obviously still small in the global aluminium warehouse stocks picture. However, what is interesting about CME aluminium is where our material is held. And it's very difficult for the audience to see this graph, but this light blue section is all of our stocks in a location, Toledo, in the United States. And so near the Canadian border, what you can see is that our big increases in stocks over the course of the last few months have been driven by deliveries into Toledo. And this dynamic of how much physical stock you have and where that stock is located is one of the key things that will drive the relative price of COMEX aluminium versus other aluminium markets. So if we are in a situation where the majority of our physical inventory is in the region which has the highest physical premium, potentially see our market trading on the futures basis at a premium itself. So this is definitely something that our captive customers have been monitoring very, very carefully, and something that they look at when deciding to trade. And in terms of trading our CME aluminium market, of course, the volumes are still small, but we have market makers for this contract. This is an example of what liquidity can look like actually during the Asia afternoon. I took this about 2 months ago at 5 p.m. Singapore time. So we have quotes on an outright contract, then we have spread quotes to the month before, the month after that, the month after that. So always a few months of liquidity on both outright contracts and the spreads. And the hours that this gets quoted from are typically from about 4 p.m. in Singapore all the way through to about 1 a.m. Singapore time. So several hours of liquidity. This bid offer can come into $1, $1.50, usually for 20 to anywhere from 20 to 35 lots per side. So this is really, if I had to name one push from the base metal side, this is it. We have given ourselves a really good footing in copper, and now it's time for the business to start to expand into another base metal market. It's difficult to do all of them at once. So of course we have to pick the largest out of the rest of them, and that is aluminium. So I think this has been a really interesting development. To give you an idea, we've already had several of, and this is no exaggeration, several of the largest physical aluminium market participants in the world trade our contract. And also 3 of the most active base metal desks from the investment bank. So the contract has already gained traction, even in its early stages of liquidity. And for any of the customers today that have looked at our copper market, certainly from an arbitrage perspective, aluminium could be the next one to look at from CME. Now, I am very aware I'm running out of time. I will just spend 2 minutes on iron ore. So I think Straits Financial has a very, very rich with the iron ore market, have been one of the dominant players. And I think many of you listening today will maybe be familiar that CME over the last 5-7 years have kind of been in and out of the iron ore market, and with varying levels of success. But ultimately, our previous efforts, we didn't find that our market share, our OI, was particularly sticky, and ultimately volumes of open interest kind of fizzled out a little bit. So today, I would like to communicate to everyone listening onto the call that CME are back to make another push in the iron ore space. As I mentioned at the beginning of my presentation, we actually have success so far in other finished ferrous products. So in the hot rolled coil space, for example, and this is going to continue to be a focus for the business going forward. So it is only right that we give the iron ore futures and options their due attention and make another push to win some sticky market share. So why CME aluminium? So first of all, any trader that also looks at copper, this bullet point here, you would potentially have a very big margin offset versus a copper and iron ore position. We believe that over the long term, we are very uniquely positioned to actually develop and grow the audience of this market due to the fact that literally everyone globally is CME's customer. And I believe that there remains this pool of liquidity when you get outside of the Asia Pacific region that probably is not yet active in the iron ore market. So we believe that we have a better position to actually expand the client base. And we also think that some of the barriers in previous years are actually being reduced over the last few years. And overall, the market is much more familiar with the idea of block trading on CME via CME Clearport. So we are here to give another push into a space that has been growing of importance and growing in terms of volumes. I believe that iron ore is going to become the next true China proxy, just as copper has been in many aspects for the last few years. And I guess the most important thing to mention is that one of the large blocks that we have had was our clearing fees were always on the high side for CME iron ore, and we do now have in place a live incentive program for customers, which gives discounts for trading CME iron ore. So really exciting for me, the first time that I have been involved in the iron ore market, to give this another push. And I'd implore any of the audience who would like to take a look at CME iron ore to get in touch via Straits on the incentive program. And we will do our best to support from the CME side. So that is it for me. Sorry, Magna, I have gone over a little bit. I'm going to skip forward on the slides that we don't have time to do. And thank you very much for your time to listen, and hope to have some questions later on after the rest of the presentation. So thank you very much.
Thank you, Sachin, for the very effective and informative presentation on CME Metals products. I believe it will be very useful to investors and traders. And for questions directed at this presentation, Sachin will address them at the end Q&A session. And to the audience, if you have any questions, please submit them through the window below the video, and our speakers will discuss the related questions during the Q&A session. Thank you, Sachin, again. And then let's welcome Eric to give us a presentation on macroeconomics of metals market.
All right, thank you very much. Like Sachin, I do have to begin with both the short version as well as the longer and more detailed version of our disclaimers, which essentially say that because CME Group is an exchange and not a broker-dealer, we are unable to offer any financial advice. So with that in mind, yeah, I think that when we talk about the metals, there's often a lot of focus, especially in a period like we are in right now, on the demand side, which of course makes sense because, as you all know, we have been hit by this enormous demand shock, which has had such a big impact on the global economy as a result of the pandemic. However, I would like to highlight that there is also a supply side that is very, very influential as well. And I think one thing that is really interesting among the four sort of major industrial metals that trade on our exchange is that copper is the one that has really seen the smallest supply increase over the last quarter century or so. Copper mining supply has risen, has roughly doubled, slightly more than doubled since 1994. You compare that to the output of steel. Steel has grown up about maybe 160%. And you compare that to aluminum or iron ore, which have more than tripled, between tripled and quadrupled their output. When you look at how the prices have evolved since the year 2000, copper is the one that has been the big outperformer. It started at a much lower price, price around 20% of where it is today 20 years ago. It has gone up to a much higher price. Whereas aluminum, for example, 20 years ago was trading at roughly 80% of the current price. And I think that that's very much a reflection of the of the very, very high level of increase in production. And a similar story for iron ore. Iron ore, we don't have as long a time series, but if you go back to say 2012, it was trading at a higher price than it is today, which may also reflect the sort of very, very abundant supply of that particular metal. I think that in terms of demand, oops, I don't know why it went back there. There we go. In terms of demand, the most important source of demand is, of course, China. China consumes approximately 40 to 50% of the various industrial metals, except for iron ore, where they actually consume more like 2/3 of it. And for China, measuring their growth, you always have kind of two choices. You can use the official gross domestic product, which, as you can see, has become kind of increasingly stable over the years up until the current year, when China was struck by the pandemic before anybody else was. But the thing about the official GDP is that it includes government spending. It includes an increasingly important services economy within China, which has very little direct bearing on the commodity markets, which is why I like these alternative measures, like the one called the Li Ka-chun Index, named after China's #2 official. It includes 40% bank loans, 40% electrical production, and 20% rail freight volumes, or sort of cargo being trafficked on railroads. And this particular measure shows a lot bigger variety of economic growth, first of all, but then secondly, it shows an extremely high correlation to where a lot of commodity prices typically are in 1 year's time. So if you look at aluminum, if you look at the Li Ka-chun Index versus the price of aluminum 1 year later, that correlation is 0.56 and 0.55 with copper, 0.49 with steel, and 0.47 with iron ore. And those are measures taken over the last 15 years, from 2005 until this year. So I think that what's interesting about this is that China's industrial economy, first of all, was not as hard hit by the pandemic as the service sector was, which is true all around the world. China's growth rate in the industrial sector did come down a great deal for a few months in February and March, down to around like 1 or 2% year-on-year growth. But since about May or so, it's been showing very consistent growth of around 7.5 to 9% per year. And I think that explains to a very great extent why we have seen this rebound in metals prices. If you look at the price of aluminum, for example, versus this alternative measure, or I should say narrowly focused measure of China's growth, you can see that it's aluminum often follows what's happening in China's industrial sector. As China's industrial sector rebounded, we've seen a rally in the price of aluminum. On the right-hand graph, you can see that. So on this previous page, we had looked at where that was 1 year in advance, which corresponds, of course, to 4 quarters. But you can see that aluminum prices tend to have a positive correlation with this alternative measure of Chinese growth, anywhere from instantaneously, meaning 0 quarters in advance, really all the way up to maybe 1.5 years in advance. So long as China's economy in the industrial sector remains strong, that could be quite bullish for industrial metals prices. Very similar story for copper. You can see copper also tends to follow what's happening with this alternative measure of China's growth. And a very similar story, of course, with iron ore. China actually consumes 2/3 of the world's iron ore. The reason for this is that in countries like the United States and Western Europe, a lot of the steel that we use in our countries has come from recycled automobiles or from bridges or buildings that are torn down and then used for scrap metal and recycling. Since China has been growing so rapidly, its economy is roughly 20 times bigger now than it was 40 years ago. There hasn't been a lot of recycling in China compared to other countries. That will come in the future. But for the current moment, they're still producing a lot of new steel rather than using recycled steel. And steel prices, of course, also tend to follow this alternative measure. But there's one thing I'd like to point out, though, on the supply side. Now, we've seen this huge rebound in prices, and so some of that is the strength of Chinese demand. But some of it, though, I think particularly in the case of copper, some of the early part of the rebound also happened as a result of mining shutdowns, particularly in countries like Zambia or Chile, where mines were hard hit by the COVID-19 virus and forced to shut down temporarily. So that created some supply problems for some of the metals, maybe in particular copper, which also explains part of the reason why they've risen. It's not only that China's industrial sector is growing, but it's also other things as well. But I think what is clear, though, from a macro perspective, is that the pandemic has largely hit the service economy. The service economy doesn't really involve consumption of a great deal of metals. But in terms of the industrial economy, in terms of housing construction, in terms of people's demand for manufactured products, the effect hasn't been quite as great. But there are still, I think, a lot of things to be nervous about. When you look at what's happened to GDP in major economies around the world, we saw China's growth rate was -5% in the first quarter. It's now improved to around +5% in the third quarter, but even that's very slow compared to what China's used to. But when you look at countries like Japan, the Eurozone, the UK, the US, you can see that the pandemic has hit the economy much, much harder than even the global financial crisis. This is sort of 2-3 times as bad as the global financial crisis in terms of its hit to GDP. Some of that has been disguised by government benefits being paid out to people who've been displaced. So the hit to demand isn't quite as obvious as you might expect, but it's still, I think, this is going to be with us for a very, very long time. When you look at how things are going in places like the United States, for example, consumer spending is still down 3 or 4% from where it was a year ago. That's going to be a burden to industrial metals producers. When you look at sort of the state of the restaurant industry, for example, which is sort of a real-time proxy for how the economy is doing, Europe is shut down again. The United States and Canada are sort of moving towards shutdowns. Mexico is not growing. It's really only countries like Australia, mainly in the southern hemisphere, that are kind of completely reopening. And of course, China itself, which has brought the pandemic under control. But but they're kind of more the exception. And so, since China has such an important role as the sort of major consumer, if you will, of industrial metals, I think it's important to think about what's China's economic future. And so there's a number of things that really worry me about China's growth going forward. So first of all, since China managed to get the pandemic under control before most other countries did, China's currency has strengthened a great deal. And so China is now facing extremely weak export markets. So we saw the huge hit to GDP from a few of the big countries, but it's many smaller countries too, with economies that are not as big, but like Russia, Brazil, India, um, you know, countries and other countries in Latin America and Africa are taking really severe economic hits. So China's exports, I think, are at risk. In part because of economic weakness, but then in part because their currency is strengthened, which also makes their exports more expensive for other people to buy. The other thing that concerns me about China is the debt levels have increased a lot. So in some ways, it's great news, of course, that China's um, economy rebounded to say almost 5% growth in the third quarter, and it looks like China's going to have another even stronger quarter now in the fourth quarter. But that has been fueled in part by a huge increase in debt. Um, since the pandemic began in China, really only in only in January, um, the government debt has increased by 6% of GDP. It's gone from 38 to 44%. Household debt has also increased by 6% of GDP. And the debt of China's non-financial corporations, which basically means every corporation that's not a bank, um, that has increased by 18% of GDP. So China's overall level of debt has ballooned by a total of 30% of GDP. Um, and so if you go back to, say, 12 years ago at the beginning of the global financial crisis, China's debt levels were very low. China's debt levels then were 140% of GDP. And China was the leader coming out of that crisis. But it led in part by leveraging up its economy, by encouraging corporations to borrow a huge amount of money and to invest. And that worked. It got GDP, it got the my alternative measure, the Lee Ka-Chun index, to grow very quickly. So we saw this massive rebound in commodity prices. China's doing that again, but they're doing it from a much higher level of debt. And so the impact on economic growth, I don't think will be as great. Um, Generally speaking, when you're at a low level of debt, and somebody borrows money, whether it's a household or a business or the government, that creates GDP. Because when they borrow money, they're either going to invest, so it goes into the investment component, or they're going to spend, so it goes into the spending component of GDP. But when you're at a very high level of debt, additional borrowing often serves just to refinance the debt. And so I think China's more in a refinancing stage, where they have a high level of debt that needs to be rolled over. The hit to the economy makes it harder to roll that debt over. China's, of course, not alone in going into debt. The US government was already running a 5% of GDP budget deficit at the end of 2019, which, by the way, is very high for being so far into an economic expansion. Under President Obama, the budget deficit got smaller and smaller, went from 10% to 2% of GDP. But under Trump, it more than doubled, even by the end of last year, as a result of the tax cut and spending measures. So right now, the deficit in the U.S. is now 16% of gross domestic product. Um, and the U.S. is now facing a choice essentially between a Senate plan for another, say, 750 billion in spending, and a House of Representatives plan for another 2.2 trillion. The Biden administration, I think, is going to, and Janet Yellen, the newly appointed, or newly sort of, you know, offered, if you will, or theoretical Treasury Secretary. She hasn't officially been named. Of course, Biden isn't officially president until January 20th. But these plans will add another 4 to 11% of GDP to the deficit. And I think Yellen and Biden are going to push for a bigger stimulus rather than a smaller one. Whether it gets through the Senate, I don't know. But in any case, the deficit in the U.S. is going to go to like 20 or 30% of GDP by next year. And the U.S. is not alone. You look at countries like Japan, France, the UK, Italy, Germany. Some of them are doing even bigger stimulus in the US. Australia is doing a gigantic stimulus. So every country in the world is sinking into just unbelievably large budget deficits. These unbelievably large budget deficits are largely being funded by central banks. For example, in the United States, the federal government issued $3 trillion of debt, and the Federal Reserve did $3 trillion of quantitative easing, not all of which, by the way, was buying treasuries. Only a portion of that was treasuries. The Fed also bought mortgages and corporate bonds and other things. But in any case, the balance sheets of the central banks are growing very quickly, and that has depressed interest rates a great deal. And this has had a really, really big impact on markets. The quantitative easing in the US mainly took place in 3 months. It was mainly March, April, and May, which corresponded to the fiscal stimulus. Um, as a result of that, the Fed's balance sheet ballooned, and we had this huge, huge run in gold and silver prices. Silver went up 150%, gold went up 50%. Since then, the Fed has pulled back. They haven't really done very much since the end of June in terms of quantitative easing. And eventually, the metals um, and equity prices started stagnating and going sideways. Um, but if the Federal Reserve or if the federal government in the US does another massive round of fiscal stimulus, the central bank, I think, will likely step in and buy that. And that could create another big, big run on metals prices. Um, when you look at the yield curve in the US, it's often a very good forward indicator of the economy. You can see back in, say, 2002, 2003, the yield curve was very steep at the beginning of that recovery. Same thing in 2010 and 2011. The yield curve now is very flat, which suggests to me that the fixed income market in the US thinks that we're going to have very slow economic growth. Um, if you look at dividend futures essentially measure what investors expect will happen to dividends for the S&P 500 in a decade going forward. The market sees those being very stagnant also. So the market in the US is really not optimistic at all about an economic recovery. Um, What's weird, though, is the dividends have really not been growing. If you compare the next 10 years worth of dividends expected today versus, say, 4 years ago at the beginning of 2017, the market expects 4% less dividends in the 10 years going forward between now and, say, the end of 2030 than they did in the 10 years going forward from 2017 to 2027. And yet the stock market in the US has gone on to hit record high after record high. The stock market's up 50%, even though expected dividends are down 4%. And so why is that? Well, the stock market in theory is a discounting machine. It takes future expected dividends or cash flows, corporate profits, et cetera, and discounts them back into the present moment. So when you look at the discounted value of future dividends, it tracked equity prices very closely until earlier this year. And so basically the entire reason why the stock market was going up in the US was because interest rates were falling, and in particular, long-term interest rates were falling. Um, so now the risk, I think, is that with budget deficits exploding, if long-term interest rates start rising again, that could make stocks less attractive. Um, and since, say, the last 8 months or so, the stock market's even peeled off from the net present value. And that has, I think, been driven by the same quantitative easing that's been fueling, in part, the rise in metals prices, along with supply problems and along with China's growth. Um, when you look at the value of the US stock market versus interest rates, you can see it tends to vary inversely. When interest rates are low, like they were in the 1950s and 60s, or like they are today, the stock market tends to support high levels of valuation. But now we have this curious situation where the stock market's extremely expensive and long-term interest rates are the lowest that they've been really in almost anybody's lifetime. You have to go back to maybe the 1930s to find lower interest rates. Um, and so this is creating, I think, a problem. So the big problem is if stocks are overvalued and US treasuries are overvalued, it means that people need to start accumulating real assets. And real assets means things like gold and silver, but it could also mean copper, aluminum, iron ore. It could mean any other kind of good. So the stock market has kind of kept pace with gold over the long term. Um, But it seems to me that going forward, that given the stock market's trading at a high level of valuation, given the low level of yields, that investors may continue to pile on to precious metals. So we may continue to see a big move there in those markets. Silver has done better than gold has in the last few months. Silver was a big underperformer from 2012 until about 2017. But silver has had this huge rebound. The silver gold ratio has now come back towards its historical average level of around 70. I think part of this is in part that mining production of gold and silver has been falling. And mining production, as you could see, of copper and a number of other goods has been kind of stagnating in recent years, ever since that price crash that we had around 2011 to 2015. So the reduced supplies, I think, are boosting prices. When you see a decline in gold and silver mining production, that tends to be bullish. They have a negative sensitivity, not only to their own, but to each other's mining production. And so, just very briefly on the oil market, oil, I think, is also, very important to metals as well, since, many countries are big producers of oil. It's a big source of revenue. And also metals mining tends to be very energy intensive. The energy sector, I think, is still very badly impaired. A lot of countries are going back into lockdown. 90% of the world's population lives in the Northern Hemisphere. Europe and the United States are still having a really rough time with coronavirus. The same is true to a much lesser extent, but still significant in places like Japan, Korea, Hong Kong, etc. So this is all happening in a context of extremely high oil inventories that are still abnormally high. They're not falling as fast as they normally would. The air travel business is still down around 60% in Europe and in North America. And the inventories of certain kinds of oil products, including ultra low sulfur diesel, are still extremely high as well. So this is a very challenging environment, I think. The oil producers have slashed production by about 20%. That was good enough to keep prices stable during the summer when most countries were reopening. But as we're now heading into the Northern Hemisphere's winter, the oil producers, I think, are facing a very challenging situation of sort of unpredictable fluctuations in demand combined with high inventories. So that's it for the economics presentation. I will pass the baton on to the next speaker.
Thank you, Eric, for sharing your insightful outlook on commodity market and metals market. I believe this is a topic that interests investors and traders in the market. Actually, for this presentation, we have scheduled a Q&A session, but since the time is running through, so you can also submit your questions, and our presenters will discuss the questions at the end Q&A session. Okay, thank you, Eric. Then let's welcome Yi to give us a talk on Base Metal Outlook 2021.
Okay, yeah, thanks, Mona. And hello, everyone. So first, let me thank Straits Financial for inviting me here today, and thanks the audience for your participation to our webinar. And in the next 15 minutes, I'm going to share with you the outlook for base metals next year. So I will first discuss copper, because for copper concentrate side, we expect global copper mine supply to rebound sharply next year. And then for aluminum, China will continue to lead the global aluminum demand recovery. And for nickel, China's nickel sulfate output may jump on EV battery demand. So let's first look at the supply side of copper. After what's shaping up to be an almost 3% fall in 2020, copper mine supply may rebound sharply next year, with our scenario analysis anticipating a growth of about 4% next year and 3.5% over a 3-year period to 2023. And both Peru and Chile's output may rebound over 200,000 tons next year. But over the next 3 years, Peru is on track to grow, while Chile may struggle. And after the pandemic disruption this year, we think mined copper supply will need the successful ramp up of Grasberg's block cave underground mine, as well as a rebound in Peruvian, and to a lesser extent, Chilean production to see a mine supply growth of 3.6%. And in Peru, from this table you can see, Antamina and Cerro Verde are the two key mines to recover. While in Chile, the recovery is evenly spread across a number of operations. And these three regions account for just over 50% of the 1.1 million ton mine supply growth next year, which is pre-disruption allowance. And the combined ramp-up of First Quantum's Cobre Panama mine would add another 100,000 tons. So taking the two project contribution to next year's supply growth, just over 60%. So this is mostly about Chile. And then if we look, Peru. And then if we look at Chile, we think Chile copper production may only grow about only 1% annually through 2026. If we look at, say, Teck Resources QB2, BHP Spence, Lundin's Candelaria, and Antofagasta's Los Pelambres. So these four combined would account for 88% of the net cumulative growth. And our base case includes Antofagasta's greenlighting a second concentrator and Centinela in 2022, which is a project would add about 100,000 tons a year. As far as Codelco is concerned, we've assumed output stay flat at about 1.6 million tons over the forecast period, which is what the company guidance for now. And we believe the balance of risks are skewed to the downside, giving financing concerns and the more heightened prospects for project execution delays. And over all these new supply, we think greenfield supply additions will account for about 75% of the new copper mine supplies over the next 6 years, while brownfield expansion will make up the 24%, and net additions from base supplies comprise about 2%. And execution risk for greenfield projects is most heightened in 2022 and 23, with sequential growth set to eclipse 600,000 in each year. And next year represents the largest growth period for brownfield expansion before falling in the years to follow. And out of the 127 total mines in our bottom-up mine-by-mine forecast, 22 are greenfield projects and 10 are brownfield, and the rest are the base supplies. So this is our forecast about the copper mine supply, because we think this is the most important factor for copper price. And then let's look at the demand side of copper. So the electric vehicle demand uptick and the renewable energy wave may take time, but both could ensure copper carries a near-term premium versus other metals, as it helps wean society off fossil fuels. And the copper is one of the nature's best conductors of electricity and heat, with a key role in improving energy efficiency in power generation and distribution. So the long-term trend for the proliferation of electric vehicles remain intact, with higher intensities of copper driving demand. But COVID-19 has delayed this versus the prior expectations. And our analysis show that copper demand in transport would fall by 22% this year, with demand only likely to recover by 2022. And by 2030, we expect transport-related copper demand, which is EV and internal combustion engine vehicles of all categories, would be around total 4.3 million tons. And for distribution transformers, electric motors, and air conditioners, we think these are the three copper-intensive end markets, while minimum energy performance standards in many parts of the world could increase the metal's intensity by about 0.5% a year. While this may not sound much, these standards have a multiply effect on already growing markets, boosting the replacement cycles. We estimate that the demand for copper across these three sectors could increase by 35% over the next 10 years, with the added requirement of more than 1.6 million tons. And air conditioner related copper demand could mount at an average rate of 4% through 2030. And many of the world's hottest regions, as measured by these cooling degree days, such as India, Pakistan, Indonesia, the Philippines, and Africa, have the lowest number of room air conditioners per household. And while the world is debating, so whether it's already close to the peak oil demand, or since the COVID-19 affected the slump in the first half, we believe copper is several years from its peak. And if we look at the most developed countries' copper demand, which tend to fall 15 to 45% post-peak, as seen in the US, Japan, and South Korea. And we think Chinese copper demand growth has slowed to low to mid single digits, but consumption, which is about 8 kg a person, is still well below the US and Japan's 10 kg at a similar GDP per capita level. So globally, the two key drivers, which are population growth and increasing wealth, are intact. But even though the gains in developing regions can stunt the advancing demand. So this is about copper. And now let's move on to aluminum. So global aluminum output, we think, may rise 3% to 66.6 million tons next year, with China accounting for 86% of the growth. And we think Chinese smelter operators are building new capacity that will come online next year to meet increasing demand from domestic infrastructure projects. And the world aluminum output in the first 9 months this year already rose 2% year over year, according to IAI, despite the falling prices in second quarter and COVID-19. The reason is smelters were refrained from closing pot lines due to the time and the high costs needed to restart operation. And we expect China's aluminum output to increase 4% next year, while Chinese smelter operators are building new plants to capture rising demand from the domestic infrastructure and auto industries. And new capacity next year would mostly comprise the low competitive pot lines, which are located in provinces with access to abundant coal or hydropower, such as Yunnan or Inner Mongolia, that can help to bring down the cost pot level for aluminum prices. And if we look at the Chinese aluminum capacity, we expect it would increase by 2.8 million tons next year, with Yunnan province accounting for more than half, as the province itself provides cost-efficient hydropower for the smelters. And total capacity would continue to grow next year after 7% year-over-year growth this year. And if we look at the capacity utilization rate, which could drop to 84% next year, so shown on this chart, and before picking up again in 2022. And if we look back, so China's capacity declined 3% year over year in 2019. That was because some smelters which faced high costs, and some other smelters conducted capacity swaps, whereby they closed old and expensive plants, then built facilities in provinces with access to abundant the coal or hydropower. But we expect the capacity would start to grow, so from this year. So this is on the supply side for aluminum. Then on the demand side, we expect China may continue to lead global aluminum's demand recovery next year on continued government investment in infrastructure and construction. And we expect global aluminum demand could rise 2% following this year's pandemic-induced 3% decline. And we've seen China orders already picked up since second quarter, boosted by Beijing's investments in the new infrastructure. And as world's biggest aluminum consumer, China accounts for about 50% of global demand, with orders potentially increasing 2% next year, which representing a slowdown from this year's 6% growth. And China's ultra-high voltage power cable construction may contribute 2% of China's aluminum demand next year. Because if we look at the state grid, it announced in April that it will invest about 180 billion yuan this year to build ultra-high voltage power grids, which is already a 60% increase from its original plan announced in January as part of Beijing's economic stimulus. And if we look at China's new infrastructure plan, which outlines the investment in areas such as technology, which requires ultra-high voltage power grids, this could help the country advance its aluminum industry to a maker of high value-added products from all of the low-end commodity grade items. Because when we talk about China aluminum market is oversupplied, it's mostly oversupplied on the low-grade commodity grade one, but we are still in need of the high-end products, and some we have to rely on imports. But we think global aluminum demand may be more vulnerable to the pandemic until a vaccine is widely available than supply side, because the rolling lockdowns can impact operation of downstream sectors such as construction sites and auto players, while smelters may be able to manage output in a second lockdown scenario as global output didn't drop in the first half after the outbreak. And last but not least, let's look at nickel. On the NPI side, we expect Indonesia to overtake China to become the world's largest NPI producer this year as new capacity comes online. And Chinese output may fall 17% year over year this year on tight supply of nickel ore after Indonesia barred the exports of the raw material since January. And an increase in Indonesia's NPI capacity during third quarter may boost this year's output by over 50%. And in Indonesia, the export ban on nickel ore already drive Chinese producers to speed up the construction of plants in the country that which helped to boost the Indonesia output. And if we look at Indonesia's NPI output, which has risen since 2016, that's when Chinese producers began building these plants to ensure a steady supply of raw materials. And by contrast, we look at China. So the producers in China may face the short supply of nickel ore and also the higher production costs versus the Indonesia NPI producers. So that attribute to China's 17% year-over-year drop of the NPI output. And if we look at the Indonesia export ban, which has left a supply gap to China, which we think is too wide for the Philippines to fill, as the Philippines' environmental policies already restrict production by suspend mining operation. And if we look at the new substitute, such as New Caledonia, which is currently the third largest supplier of China, but only accounted for 3% of China's imports. And for that country, it still needs time to ramp up the output. And if you look at the Philippines, so Philippines nickel ore output, which accounted for more than 50% of China's 2019 imports, will have little room to grow further this year, as the environmental restriction includes such as production limits and mining activity suspension would throw up formidable barriers to production and constrain its ability to export more to China. And the Philippines already supplied 76% of China imports in 2014. That's after Indonesia's first export ban introduced that year. and already increased from 76% to more than 95% after as 2016, 2017. And so we think the problem with the nickel supply is the ban of Indonesia would encourage the output MPI in that country. And for Chinese MPI producers, they have nowhere to look for nickel within the short term. And these are about the traditional nickel consumption, so maybe on the stainless steel. And how about the new one? The new one, which is the nickel sulfate, which can be used in the EV sector. And we expect China's output of nickel sulfate could jump 22% next year and rise another 5% in 2022 because of growing demand for power batteries used in EV and increasing use of the nickel-rich cathodes to cut costs and raise energy density. If we look at China's nickel sulfate demand, 69% of it demand coming from the power batteries. But China's output of nickel sulfate may fall 16% this year, which is due to the pandemic. And the use of the nickel-rich cathodes is increased in the EV battery industry to raising energy density and reduce costs by using less cobalt, which is more expensive than nickel. And we've seen Chinese nickel sulfate producers cut capacity and reduced operating rates amid narrower profit margins this year, as cost of raw materials increased due to tight supply, but selling prices still fell due to weak demand. And the nickel-rich cathodes, such as NCM 811 and NCA, with nickel accounting for more than 48% of total metal content, may see market penetration rates rise as EV battery makers gradually switch to low-cost but higher energy density choices. And we think EV battery makers tend to use less cobalt but more nickel, as nickel is cheaper, which could boost demand for nickel sulfate. And the cathodes with less nickel content may be squeezed out of the market. And after power batteries accounted for more than half of China's nickel sulfate demand, we believe the shares looks likely to increase further in 2025. To summarize, we expect global copper mine supply to rebound sharply next year, and China will continue to lead the global aluminum demand recovery. And for nickel sulfate will continue to be driven by the demand of EV. So this is the end of my presentation. Thank you.
Thank you, Yi, for providing your insights on base metals market outlook. I believe this would provide important perspective on base metal market for the investors. For the questions directed at this presentation, Yi will address them at the final Q&A at the end of the webinar. Then let's welcome Hou Zhenhai to give a talk on the macroeconomic and investment outlooks in Q4.
Hi, good afternoon, everyone. So I will give this presentation about our macroeconomic and investment outlooks towards the end of the year, and also a outlook for the next year. So we start from this presentation about the overall macroeconomic situation right now. First of all, we all know that the COVID-19 is a very big event, probably the most important event this year. But we know there are some certainties about that, but also some uncertainties about it. The certainty is that we will see that the pandemic will get even worse over the next couple of weeks or months, even because that we see the outbreaks in the US and also in the European countries has been getting much worse over the last couple of weeks. And now that we see the daily new infections has been mounted to nearly like 200,000 cases a day in the United States, and that would be a very severe situation that going forward, that we will see more deaths were coming out, and there will probably have some new measures taken to control that, including some like quarantines or some social distance policies, and that will further affect the economy growth in the United States and also in European countries, because that we know that we are heading into the holiday seasons in those countries, and if we have some restrict control over social distance, that probably hurt some outdoor activities in those countries, and that would make a blow over both the consumptions, also the service industries in those countries. So we know that the situation over these countries has been quite severe, and also that we likely have another 1 or 2 months that we are experiencing in a further deterioration in the situation of COVID-19. But there are some hopes about the vaccines. But I think the vaccine probably still need a long time to get effective, because that we know that the production of those vaccines and the test over those, if the efficiency of those vaccines still needs time, though the market has some very good expectations for the effectiveness of those vaccines, but I wonder that it could take a long time, and also a much effort from all the governments around the globe to make that effective. So we've seen that for the short period of time, probably the social distance quarantine measures is still the only way to control the widespread of the virus. So that makes we think that the global demand, especially in the holiday season in the Western countries, still face some downside risks. But another uncertainties we would like to mention here is that we don't know that whether we will have another stimulus coming out from the United States, also like from the EU countries, as we've seen from the slides that we already have some big stimulus coming out this year from both these countries along the Atlantic Ocean, that you see in the European countries that the incremental government debt has amounts to over 10% of GDP of France, like 7% of Germany, and also 9.5% of Italy. So those are big numbers, considering that these European countries has been taken some really strong measures control their debt growth over the past of a decade. But this year is a very strong growth year of their debts. But you look at the United States, there's the same case that we see for the first 3 quarters, the U.S. Fiscal deficits has accounted to 15% of total GDP, and that's the biggest amount ever since the World War II. So we see this is a very tricky part of investment, because first the COVID-19 has some severe impact over the global demand, but also we see the global governments has been giving so big amount of money into the markets through the fiscal and monetary policies. So that's combined see a tricky part of our macroeconomic situation right now. You look at the picture that you see that this has been all unprecedented. So But at the end of the day, we're looking at the household income of these like United States, for example, that before the COVID-19, the average person's monthly income in the United States is about like 4,700 something that every month. But after COVID-19, it's actually the average monthly income of the United States people that per person, that the number has been growing actually to like 5,300. So that's a 6% roughly in growth of their actually monthly income. So I think that's why we see a quick recovery of the demand once if the social distance policies have been lifted in the United States, because that people actually they don't get hurt too much about their income, though there's a huge amount of employment, but people get money from the government directly, so they're actually the average income has been growing this year after the pandemic. So, but because of the social distancing policies, we see their actually spending has been hurt, because a lot of people have just like we are more like buying products online, and then we are not going outdoors. So their spending has been hurt by that. But on the other part, you can see their savings growing pretty fast, and that's probably the fast growing of the saving rate in the United States ever since. So we see the growing of the savings, and also they have a lot of money to spend if these social distancing policies has been over. So that's why we see in Q3 there's a strong rebound of the demand, not only from the consumption, but also from the investment, like they're purchasing houses, buy more stocks from the individual investors. So that's a phenomenon that we don't see ever in the past decade. And if we look at these numbers, the retail growth in the United States, like from July and August to October, these numbers are growing really strong. That year-on-year growth is about like 15%, especially in those that cyclical sectors. Look at automobiles and some home appliance, electronics. These things has grown very fast compared to before. So that's a very interesting phenomenon. But I think this because that people actually get paid from the government, not from their employers, but they still have the money. So when Evans looks okay, they go out and buy more products with those money. So that's why we see in Q3 there are strong rebound of the demand. But not only these retail growths, we look at these new home sales in the United States. It's growing also very fast. It's growing likely 50% year on year in those 3 months, namely in after July. So people are not actually only just buy products daily, they use on their daily life, but they also purchase houses, especially those rich people. They buy more expensive houses, so to see the price of those houses go up as well. If you look at it, these data. To sum up, I think this is generally a monetary phenomenon because the global central banks, including the U.S. Federal Reserve, ECB, and the Bank of Japan, combined has been throwing over $7 trillion US dollar into their balance sheet. So that's a huge number, because before the pandemic, these global central banks only run their balance sheet about 15 trillion US dollars, but now they have a balance sheet over 25. trillion US dollars. That's a growth of 50% nearly a year on year. So that's a thing that we have never seen in history. So also we will likely see these uncertainties about not only just about the vaccine, not only just about the pandemic, but also we will see these huge amount of money given out through fiscal and monetary policies. Where would they go? Like, look at these pictures. Just like some guest speakers had just mentioned, that we see the equity prices globally, and not especially in the United States, has been growing to the historical highs, and also we see the commodity price goes up as well. So that's, we think, also helped much by these global monetary expansions. So we will see a tricky combination of these macroeconomic outlooks here, that the deterioration of the pandemic in the US and also in European countries might negatively impact the year-end shopping season. But it's also important to know that we will have probably more money coming out, especially if there's another round of fiscal stimulus coming out from the United States, especially after Mr. Biden get elected. So we also know yesterday that Janet Yellen has been the next head of Treasury Department in the United States. So that's, the market is anticipated more like fiscal stimulus, because Janet Yellen has been the chair of Fed for a couple of years, and he in her administration, he do a lot of new quantitative easing. So the market is anticipating more coming out from her about the fiscal policies. So that's a interesting things for our commodity investors to know, that probably there's some uncertainties about the global economy, but also we will see probably more like these kind of very accommodative policies coming out in the next couple of months or even quarters. So, but under the longer term, we also will be focused on several important questions here. The first is that the first one is, what will a Biden administration bring us? As you know, that Biden was elected as a new president, and these policies, he may have some new policies come out, including that some back to the Paris Climate Agreement. There will be overall more investments into new energy or new environment protection industries, but also that we will see the restriction of some carbon dioxide emissions about these policies. But there's a policy over a long time. So there will be affected these commodity supply and demand over time, especially on the petrochemical side. But also we will see the new administration and the Biden will put more efforts to make a new, like I said, new stimulus coming out, probably over $2 trillion US. But I think it's still down to whether they can control the Senate on the election of Georgia on January the 5th. If they can control the Senate, I mean the Democratic Party can control it, the more likely they will see more stimulus coming out. But if they couldn't, we probably see much less about that. But also we were focusing on these China and the US relationship over the next few years. I think the overall trade war will get will put an end to the trade war under Biden's administration, but also we don't expect they will get all these tax policies from Trump administration over, but because they were still like to protect especially on the intellectual property protections, key technology controls. Also, they would like to China to open up their media, internet markets. So I would say there are still more some disputes, conflicts between the two countries, but we don't expect to see an even worse trade war between these two countries. So I think that's probably a good news to know that the trade war probably come to an end, and also that we were like to see the Democratic Party and the administration would put more efforts to let the China to appreciate the RMB, because that will be a more convenient and a more good way, better way for the United States to compete. So we see there's probably a new trend is forming that the RMB probably would like to appreciate further over the next couple of quarters. So that's over time. I think it will be a long-term impact that the new Biden administration will bring to us. But we then move on to the focusing on the Chinese policies. Chinese policies, I think the most important thing we'd like to introduce that we see that the general policy stance of the Chinese government has been changed since that end of July, when they have these Politburo meetings in late July. They were changed the macro policies towards a more neutral policy stance, and they take a couple of measures out of that. The reason that they changed the stance is because that they see first that China has been quite successful to control the spread of the virus, and also we will see China has some very resilient economic growth in Q2 and Q3, and also exports is not as bad as expected, thanks to the global recovery of demand in the Q3. So this gives the government, Chinese government, more confidence that we can cope with the downside risk of the economy. So they gradually change their policies towards a more neutral one. So, but also the other side we can see is that the resilience of the Chinese economy has been largely thanks to the growth of Chinese property development. The property investment in China has been grown very strong, over a 13% year-on-year right now. So that's a very strong number, even compared to the normal years. We probably have the fastest growth of the property investment over the past 5 years. So why we are there? Because that the policy that we had in the first half of this year, just like we mentioned, the household debt growing at a very fast speed, and more people that are going buying in the house because of these accommodative policies, and also these expansion monetary policies in the first half. So in the second half, the government gradually changed their view, that they think that probably the growing of the property investment and also the house price has been too much for the people, and also too high a leverage ratio. So they gradually changed the policy. So then we'll see that since late August, we see that the leverage has been curbed by the government to the property developers. The new regulation said that they have to lower their debt to asset ratio and a reasonable amount by the end of this year. So that's give the property developers some pressure that they probably needed to first to sell their home, the houses at a faster pace, and also they probably will lower the price. So we see over the past 2 months the overall average sold price of the Chinese houses has been actually decreased over the past 2 years, over the past 2 months. But also this also like led the developers to fasten their paces on the new developers, because they want to keep on building new houses and finish those projects as soon as possible to get the money back. So because in China, that if you not in the first tier cities I mentioned, I mean, if you are in the second tier or third tier cities, smaller cities, you can sell the project, to sell these houses once the construction of the basement has been finished. So that probably just only 3 or 4 months after new home started. So that's why we see a very fast new home started number in the Q3, because these developers they can be able to sell those houses by the end of this year. So that's a very important factor. I mean, probably most global commodity investors don't know, because they see a very strong number. They see a very good demand in domestic China, but I think that largely thanks to this kind of impetus from the developer. They wanted to fasten their cycle of building, because they want to sell those houses before the end of the year, as the new regulation demand them to control their debt to asset ratio. But that translates into a very strong growth of the developer development. But also that we see a control over these purchases of houses now, that especially I think in the fourth quarter, we'll see more control of this on the house side to leverage buying more houses. And then we see, because that in the Q2 and the Q3, that the monthly growth of the householders' mortgages has been really, really strong. That over I think 600 billion RMB a month. That's the highest ever in the history. But in the first quarters, that number will decrease quite significantly, given this current policy environment. And also, we also want to know that mention that the Chinese central bank, the PBOC, has been very reluctant to cut more interest rates, and also like cut the TRR over the next period, maybe next 2 or 3 quarters, I think, because they want to keep a more neutral stance over these macro policies, the monetary policies. But also, we probably, some of you have noticed that there is a liquidity problem, especially in the credit market here in China right now. But even under this situation, I don't think the PBOC will do more, like to cut rates or do more easenings. But they will do some open market operations through these MLF, as mostly from the MLF, I mean the midterm loan facilities, to the interest rates from going too high. But that said, we don't expect these interest rates in China will go down in the near future. And also, we'll see the developers begin to fastly decrease their land purchases. I mentioned that they would fasten the house building activities, but on the other hand, they were quickly decrease the activity on land purchases because they want to control the debt ratio. So they want to get money back. So don't spend more money on the new lands. But that will give a impact over next year. I'm saying not this year, not in fourth quarter, but probably the next year, middle of next year, we'll see a downturn of the property development activities in the middle of probably in the Q2 or Q3 next year, because that's a lagging factor. So probably, I think historically 6 months later than the land purchases. So I mean, this is downside risk, but not here, but probably still 6 months from now. And also, we will see that the local government, because the land purchases has been going down, so their income on the land sales will go down too. So that means that the fiscal situation of the local government has been not in a very good shape, I think, towards the end of the year. So that's also why we see more like some in those provinces, like in northern China, they probably have some problems to pay down the debt by the end of the year. That also we see some defaults on these even state-owned enterprises because of these situations. But I think generally this will not lead to a big financial problem or financial crisis in China, because that's comparatively a very small part of the financing vehicle in China. But also we will see that some government were like continue to issuing more debt through this central government program, such as we know that these local government special purpose local government debt vehicles. But the real problems actually comes from the corporate side. The corporate debt market has been frozen since about 2 weeks ago. So the corporate bond market has been frozen. Then a lot of issuance have been canceled because there's defaults coming out from those state-owned enterprises, and also that the lack of liquidities in the bond market has led to a further growing of widening of the credit spread, also the growing of even the interest rate. So I think this makes some problem here towards the year end. I mean, not from the macroeconomic standpoint, but from this market liquidity point. I mean, the Chinese domestic liquidity situation. We see both on the long end and the short end, like the interbank lending rates or the Chinese long-term 10-year treasury yield, they all goes up over time. So over the past 3 months, so it's a very sharp comparison between the situation in the global wide. I mean, in the United States or EU, that you see that the yields are still very low. But in China, that the yields has been go way up, has been even higher than what we had before the pandemic. So that's why we see the liquidity situation will hurt the domestic bond market in China. But for commodity investors, I think we are not to worry much about that, because the commodity demand right now is so far so good. So I don't think that will get a much impact over the commodity market, especially in Q4. But that could be a risk next year that we will see after Chinese Spring Festival. We probably see a weak demand coming out like next year in China, but it's not in Q4, I think. Right now, the favorable factors in the commodity markets, to sum up, the first is that the domestic consumption and the fixed asset investment, especially property development, very, very good. But also the inflation expectations are boosted the market sentiments. And also that there are some other kind of factors. But I think these were largely help the Q4 commodity price for further going up. But I don't think that over the next year we'll be that optimistic about the commodity prices next year. So okay, that probably to sum up my views, and I think I can finish here, so we can talk if you have any questions. Thank you.
Thank you very much, Mr. Ho, for your insightful and informative talk on the macroeconomic outlook and investment strategies. Next, let's welcome James to talk about base metal inter-exchange arbitrage opportunities. Welcome.
Okay. First, I would like to thanks for all the audience who stay with us till now. So today, actually, I will give talk about the commodity arbitrage trading. I think in the market, it's very popular for the traders doing the arbitrage trading in commodities. In general, the commodities need the storage space and the transportation to make them available across the world. Also, they are traded in the different forms across the markets. Many times, there is a difference in the price of a commodity in spot and the futures market, and also across the exchanges. This difference in price creates an arbitrage opportunities wherein the commodities can be purchased or sold in different markets at different rates to generate the returns for the investor with minimum or no risk. Look at the different arbitrage strategies. You can opt for while trading in commodities. You can have the cash and carry trade, or either the future inter-month spread trading or inter-commodity strategies. Also the inter-exchange arbitrage strategy. So today I will only focus on the interchange arbitrage strategies, which the trader actually can exploit the price difference for the same commodity on different exchanges. The price difference mainly happens due to the liquidity, instability, and the specifications of the contract. We just use a copper as an example. So looking at the comparison table, we can find that the specs are different. Copper quoted in the different currency and the unit of the rates with the different physical settlement procedures. The market participants are also different. For example, elbow and high-frequency traders, hedgers, are the main participants at the LME market. But you can also see the latest contract, which launched in Shanghai. The main participants are the day traders, the retails, or the China domestic physical traders, plus some international players. So now we go to the slide 2. When you can looking at the CME LME, the copper forward curve. When we do the arbitrage between the different exchanges, you also need to consider the forward curve, the rolling cost. Obviously, the CME copper is at the consistent contango structure, and the LME is contango linear forward, but backwardation in the 5 forward months. If we go to the slide 3, you can see both the CME and the LME copper contracts are physically settled. So the metal may be delivered or received in the respective exchange warehouse network to close the position. So on the LME side, it's on the pound day copper can be settled by delivery or receiving a warrant in respect of the copper in any of the approved global locations. The CME copper warehouse network, on the other hand, it's limited to the just US locations, which makes the price more US specific. Therefore, the CME LME, the copper arc, can be found to typically correlate to the regional US premium. When copper is bought and sold in the physical market, it's usually transacted based on the LME official price plus a premium to reflect the benefit of obtaining the macro in a desired region. These regions premiums are added to the LME price and negotiated off exchange or are surveyed by the various market information providers. You can see this is more correlated to the US premium. So now let's go to the next slide. We also can talk about the IE and the LME arbitrage. So looking at the LME and the Shanghai copper arbitrage, as you may know, the IE launched the bounded copper futures contract on the 19th November. It opened another opportunities for market. Copper price on the LME and the Shanghai are strongly correlated. It's about 96%. But sometimes the price difference will arise due to the asymmetric information or the fundamental disparities. Given the right to arbitrage opportunities, we just give the formula and you can just take a look. For the IE, the theoretical import price actually equals the LME corresponding month's price plus the Shanghai Yangsan port premium. Then we divide by the FX rate plus the port surcharges. So let's say if the IE price is higher than the theoretical price, so the traders can just buy the LME and sell the IE. On the other way, let's say for the IE theoretical export price, actually is equals to the IE corresponding months times the FX rate plus the location premium. If the LME price is higher than the theoretical price, then we can just simply buy the IE and buy the IME and sell the LME. So this is a very straightforward formula. Actually, we are quite happy to share more information on the arbitrage between the different exchanges. Due to the time limitation, I think that's all for my presentation today. And if you have any further inquiry regarding the arbitrage on different exchanges, we are happy to discuss with you after this webinar. So thanks, Mana. So I just
thank you. Okay, thank you, James, for sharing with us. Since we're running out of time, so we may just end our webinar here. I would like to thank all our guests today for joining and for your valuable input. Also, I would like to thank all the audience for listening. We'd love to welcome you back to our upcoming webinar this Thursday on Energy. Thank you and hope to see you soon on our future webinars. Thank you. Bye.